Move over. Okay. Welcome. Good morning. Thank you for attending the CPM Group Gold Yearbook 2017 briefing. We're moving into the digital age here and moving away from the old format that we've had for the last 20 some odd years of having physical briefings in New York. We want to start by thanking our sponsors and partners. We have a number of sponsors, many of whom have been with us since we started taking sponsorships in 1996. CME Group, Commodities Now, Fidelitrade. Could you please stop that? Okay, Gold Corp, Goldfields Limited, ISRI, Scrap Recyclers, Kitco, Monex, NOAA, and Savin. So we have a broad range of entities, from mining companies to scrap recyclers to companies that provide investment products and fabricated products, as well as institutional investors and exchanges. We also have 3 Chinese partners: the China Gold Association, China National Gold Group Corporation, the largest gold mining company in China, and Jingyi Gold, which is one of the largest distributors of gold products within China. These companies translate our yearbook into Chinese and distribute it there. We will have a briefing in early May on the gold yearbook in China, as we have done for the last 4 years or so. And we're very proud to have them as partners on this project, as well as in other projects that we are developing with them. The format today will be that I will talk a little bit about the gold price, the macroeconomic environment as it affects gold, and the investment demand for gold. About halfway through the investment demand session, I will pass the microphone and the advancer over to Rohit Savant, who is our Director of Research and our Chief Precious Metals Analyst and our Chief Gold Analyst, and the primary author of this year's yearbook, as he has been for several years. And he'll take it through the rest of investment demand, fabrication demand, total supply, and then he'll pass the baton back to me for central banks' official transactions. We'll then open it up for questions. When the questions session begins, you will have the capacity to either ask questions by typing them in, and our colleague will read them off, or you will also be able to speak them to us through some sort of capacity that I'm not familiar with. So looking at the gold. Gold prices reached a cyclical bottom in December of 2015, about the time the Fed was starting to increase interest rates for the first time. Gold prices rose sharply in the first quarter of 2016. They kind of plateaued. They fell sharply after the election, reached a new low in the middle of December of 2016, about the time the Fed was increasing its interest rates the second time, and since the beginning of the year have been rising sharply. Prices around $1,255, $1,260 today. CPM Group's expectation is that the price of gold will rise modestly in the first half of this year and will begin to accelerate in the second half of this year as economic and political issues start to increase investor disenchantment, skepticism, and concerns about a wide variety of topics in the United States, Europe, Russia, and globally. Our economic view has been, since around 2010, what we call muddle through, an extended period of low growth, subpar growth, accompanied with a higher unemployment than one would like, low industrial production growth, low interest rates, and low inflation. At the bottom of this chart, you can see that in the period 1980 to 2000, we had about 3.3% growth on a global basis. Franco Modigliani won a Nobel Prize for a variety of economic research, one part of which was that he saw that 3.3% real GDP was what he called a non-inflationary sustainable economic growth pattern. And during that period, we had tremendous growth on a global basis. We had deregulation and the opening up of a number of global regional economies and national economies, which saw a great deal of prosperity. From 2000 to 2007, we saw an acceleration of that growth rate and to about a 4.5% annual rate. That was unsustainably high, and it led to the Great Recession and the global financial crisis in 2007-2009. In the 7 years after that, from 2010 to 2016, we saw growth slow down dramatically, about 18% from the period prior to 2007. But we saw about 3.7% growth, still relatively high. Going forward, CPM Group is looking for about a 3.3% growth rate over the coming decade. You'll notice that on the bottom line, which is the advanced economies, we have a recession showing up in the United States in 2018 and continuing into 2019. It's a relatively shallow recession at this point in our view, although we think that the prospects or the potential for a more severe recession have increased in the last 4 months compared to what they had been prior to, say, November 9th, 2016. Basically, though, we're still seeing relatively stable growth, the muddle-through economy, subpar growth compared to what it was in the period of 2000-2007, and we see it continuing that way. We do not expect strong growth in the United States. As I said, we wouldn't be surprised to see a recession in 2018 into 2019. We also do not see the U.S. growing itself out of its debt problems. There has been talk about U.S. growth being goosed up to 3, 4, 5% real GDP. You can see from this chart several things. First thing you'll see is that in the 50s and 60s, the U.S. real GDP, in fact, averaged about 4.5% per annum. You'll also see that the economy was much more volatile back then. We had much more frequent and much more severe recessions than we had had in the period 1980 through 2007. So you had increased volatility and increased growth. You had a variety of issues going on then that simply do not exist now. By the 1970s, you saw the volatility continuing, but you saw growth average 3.4%. That fell to 3.2% in the 80s, 3.4% in the 90s. In the 2000s, it was about 1.7% growth rate. And over the last 7 years of recovery, we've seen about a 2.1% growth rate. CPM Group's expectation is that we'll see about 2.3%, 2.4% growth rate this year in the United States, perhaps about 1.5% punctuated by a recession next year, and growth remaining well below 3% for the foreseeable future. So we don't see the U.S. growing itself out of its debt and deficit problems. Speaking of the debt and deficit problems, these are the total U.S. government debt. And you can see that through James Carter, we had about $1 trillion of debt built up, mostly in the period of the 1940s through the 1970s. Under Ronald Reagan and George H. Bush, we saw total debt rise to $4.5 trillion. Clinton actually added about $2 trillion to the debt, but then he paid down $1 trillion of it toward the end of his administration. So he looks relatively modest in terms of his debt spending. We saw about a $6+ trillion increase in the total debt under George W. Bush, and we saw about a $7 trillion increase, $8 trillion under Obama. The Congressional Budget Office expects that if some of the policies pursued by the new president come into play, we could see this rise to as high as $30 trillion or more over the next 4 to 8 years. So it's a very problematic situation. There's a lot of structural expenditures there that are not going to be solved easily, and it remains a problem. On the flip side, we continue to have large excess reserves at national banks in the United States. You can see that prior to 2008, we never had excess reserves. Any bank that had excess reserves at the end of a business day lent them out to other banks to balance their sheet. In the financial crisis, the Fed started paying 25 basis points on excess reserves, and we saw excess reserves to rise to about $2.7 trillion in the United States. We saw similar policies and similar consequences in Switzerland, the UK, the Eurozone, and Japan. There's a tremendous amount of excess reserves that are backed up in depository institutions, banks primarily. And of this $2.2 trillion that's in the United States, most of it is in about 8 to 10 banks. This continues to be a problem. This is one of the reasons why we haven't seen the inflationary consequences of monetary largesse, is that a lot of the money that was lent to the banks in exchange, or sold to the banks in exchange for bonds of various sorts over the period 2008 through 2013, actually has remained in the banks. It's not been lent and it's not been spent. It hasn't had an inflationary consequence in the real economy. It's primarily had an inflationary consequence in the financial markets, primarily the stocks market and the bond market. Should this money become mobilized at some point, it could have inflationary consequences, but to the world's consternation, the money hasn't been mobilized to any significant level, and for the foreseeable future, excess reserves probably will remain high as part of that muddled through subpar growth period. In terms of inflation, inflation comes from both monetary and real economy issues. You can see on the left-hand side that core inflation has risen a little bit, but it still remains relatively under control, around 2%. The headline inflation, which includes food and energy, which is excluded from the core because of the volatility in the food and energy markets, has shown greater increases. And one of the things that we've seen in the Fed policy statements recently has been a focus more on headline inflation at the expense of core inflation, which is probably not an accurate way to assess inflationary pressures in the United States. Nominal and real interest rates, meanwhile, remain relatively low. A nominal T-bill rate has risen 3 times now since 2015, but it remains about a very low, sub 1% growth rate. And you can see that real interest rates remain negative for the T-bill. The Fed's expectations continue to be downgraded in terms of how high interest rates are. On the left-hand side, you can see that in June of 2016, the Fed was looking for interest rates to be somewhere between 2 and 3.5% by 2018. If you look at the right-hand side, you can see that it's now looking between 0.75 and 3.5%, and there's been a noticeable downward shift in expectations on the part of a number of the members of the Federal Open Market Committee. We've seen this over the last several years since the Fed has started to produce these. They've had outsized expectations of real GDP, employment growth, inflation, and interest rates, and they continually reduce the growth rates that they're looking at. Our final comments on the overall economy is the dollar. The dollar has been expected to fall for years, and over the last 6 years it actually has risen. CPM Group's expectation is that the increase in the dollar is largely behind it. We do not expect the kind of increase that we saw in the second half of 2015 when people were bidding the dollar up in expectation of interest rate increases in the United States and relatively stronger growth in the United States compared to elsewhere. We also don't necessarily see the dollar falling sharply. For the dollar to fall sharply, one has to have much more confidence in the Eurozone, the UK economy, the Swiss economy, the Japanese economy than most people do. In terms of the UK economy, Brexit probably will reduce long-term growth on the order of 10% over the coming decade. That doesn't mean that growth will contract by 10% in the UK. What it means is that if we were looking at 2% per annum growth rates in the UK over the coming decade, we probably are now looking at 1% growth rates in the UK. A good portion of the growth that will not occur in England is likely to be transferred to Germany Frankfurt specifically, and the United States, New York specifically. So it's not necessarily a net loss for the global economy. There are other problems in Europe which could have a net loss for the global economy. As a result, we think that the dollar will remain the reserve currency of choice for the foreseeable future. It probably will trade sideways to upward in a volatile fashion over the next couple of years because, quite frankly, while it doesn't look like it has a lot of good reasons to fall, it also doesn't have a lot of good reasons to rise. That's important for gold for a variety of reasons. Gold doesn't trade against the dollar. Gold trades against currencies. And over the last several years, we've seen the dollar very strong. So investors, when trying to assess where to allocate their money, have tended toward dollar-denominated assets. When there is no currency of choice, either the dollar or the euro, people will move money into gold and silver. And our expectation, and we're already seeing this, is that investors will look at the dollar, they'll say, it probably isn't going to rise much, but it probably isn't going to fall much. It seems highly valued, so I'm not particularly bullish for it. But I also don't necessarily see it falling sharply. And in that kind of environment, you should see increased interest in gold and silver from investors. And in fact, you already are seeing that. Our expectation had been that during the first half of this year, you would see investors focusing on the idea of tax cuts and to some lesser extent infrastructure spending in the United States, which would goose the U.S. stock market. As the stock market continued to be strong, we expected that foreign investors would buy dollars in order to participate in the U.S. stock market, and that would help the dollar stay strong along with the U.S. stock market during the first half of this year. Our expectation was that by May or so, these things would be plateauing, that disenchantment and skepticism would be rising about prospects for both a tax cut and for infrastructure spending in the United States, and that you would see a period of time begin to emerge in the middle part of this year and accelerating in the second half of this year, in which investors would be less interested in the dollar, less interested in stocks, less interested in industrial metals that would be used in infrastructure spending programs, and they would be more interested in gold and silver as financial assets and portfolio diversifiers. May be too late. We may actually already be seeing that reassessment of economic prospects emerging in late March, and it could continue into April. But that's our overall economic view. Now, before talking about investment demand today, I want to talk about gold's role in a portfolio. We, CPM Group, updated this data late last year. Many people will have seen this chart before, but they'll notice that the numbers are radically different. Ibbotson Associates originally did this work in the early 1980s, using data from 1968 through around 1980, a period of time when the gold price was free. And basically they said, if you take a portfolio that's 50% S&P and 50% T-bills, and you start adding gold to it, initially as you add gold to it, the risk, which is defined as the volatility of the overall portfolio's value, declines while the return rises. And at some point, you start seeing a flexion where you see both risk and return starting to rise. And the important part is, where does the risk start rising more rapidly than the returns? In the early 1980s, this chart showed that that flexion point was around 5 or 10%. And for 30, 40 years, people would say you should have 5 or 10% of your portfolio in gold. CPM Group updated this data through 2016, and the flexion point is now 25 to 30%. I'll show you on the next chart. If you have a portfolio of T-bills, you have a flexion point of around 30%, and if you have a portfolio of S&P and T-bonds, the crossover is closer to 27%. At that level, the risk that you're adding begins to be greater than the returns that you're adding. Now, these are extremely high allocations to gold, and a lot of people have expressed surprise. And why are these numbers different from the ones that we saw 5 to 10% in the early 1980s? And the answer is the economic realities and political realities that have existed between 1980 and 2017. We've seen several stock market collapses and crashes. We've seen an extended period of very low interest rates. We've seen bond market rallies and bond market declines. And we've also seen an extended period of time. We've seen several gold bull markets in 1985, 1988, in the early 1990s, and an 11-year bull market from 2000 to 2011. You put that better return for gold in with worse returns for stocks and bonds over the last 40 years, and you get this kind of allocation. So it's a very interesting figure. Turning to investment demand, CPM Group has talked for years about the idea that we've had an upward shift in the investment demand curve. Since 2000, 2002, we've seen more investors buying more gold in more parts of the world at higher prices for a longer period of time than ever before in history. Basically, the difference between the blue bars here and the black bars here is that in the blue bars, those are years in which investors bought less than 20 million ounces of gold. And you can see that for much of the period of time of free gold prices from 1967, 68 until 2002, we spent most of the time with investors buying less than 20 million ounces of physical gold in a given year. In the early Audis, we saw that upward shift, and basically from 2002 to 2012, we saw investors consistently buying 20, 30, 40, even 44 million ounces in any given year. An extended period of bull market, which also saw record gold prices rising from $250 in 2000 to $1,900 in 2011. We saw a big pullback in 2013, 2014 to less than 20 million ounces a year in physical gold demand. In 2013, you actually had a lot of demand, but this is net demand because you also had a significant amount of bullion being sold by investors who were moving away from gold 15 months after the price had peaked and had started to fall. In 2015, we saw a strong surge of investment demand, mostly in the second part of the year, and that increased again in 2016. And you can see here is about 27 million ounces of net investment demand for gold last year, up sharply from the previous year and up sharply from 2013, 2014. And that was reflected in the increase in prices. Our expectation is that investment demand will be about 27 million ounces again this year. That may be a conservative number. It depends on what's going to be happening politically and economically in the world. Now, what we're seeing is that investors are returning to gold. There have been a wave of investors who are new to gold, who formerly did not invest in gold, entering the market in 2016 and to some extent in 2015 and in early 2017. There's also been a return of opportunistic generalist investors who had exited the gold market in late 2011 and early 2012, coming back into the market because A, the market looks more bullish, and B, the prices are rising. There are investors who have moved into gold equities as well as into bullion. We have seen some investors who have focused on bullion instead of equities, seeking a pure exposure to gold. And we're seeing signs of fatigue and disinterest among some of the traditional physical gold investors and markets. People who bought gold based on the view that the world was going to collapse financially or economically or politically, that the dollar or the euro or the treasury market or the ECB would fall apart, or that there would be hyperinflation. There have been people who have become disenchanted in gold and have sold their gold, even as these new wave of investors are coming into the market. We expect these trends to continue going forward. One of the things that CPM Group has been doing a lot of work on really over the last 50 years, but more specifically over the last 2 years, is do you buy gold out of fear or greed? And we have had people tell us that the difference between CPM Group and a lot of companies that sell gold to investors is that they sell gold based on fear of catastrophic economic or financial failures. And we sell gold based on a combination of fear and greed. Yes, you should have some gold as insurance there, but there are also reasons to believe that you can use gold for purposes of capital appreciation. As these events have not occurred, as I said earlier, you've seen some disenchanted investors leaving the market. Our view is that investors should buy and hold gold for a number of very good reasons. First off, you should have it as a store of wealth, diversifying your exposure away from a single national currency that denominates most of your wealth. You should have some gold as catastrophic insurance in case things do fall apart. But you should also have gold as less catastrophic insurance, a portfolio diversifier that helps you smooth out the risks, the volatility of your wealth or your individual portfolio as a subset of your wealth due to changes in stocks, bonds, and currencies. And you should see it also as a vehicle that can generate both long and short-term capital appreciation. CPM Group's estimate is that toward the end of the dollar gold standard, around 1968, perhaps 4 to 5% of the world's wealth was denominated, private sector financial wealth was denominated in gold. As we moved away from the gold standard and as we saw a 11 to 12% per annum compounded growth rate in paper assets, stocks, bonds, corporate debt, over the ensuing 20 some odd years, you saw the amount of the percentage of financial wealth decline that was in gold decline to about 0.2%. It's important to note that during this period of time, investors were not selling their gold, and the gold price was actually rising. But the gold price rising even as investors were buying gold, and you remember it was less than 20 million ounces a year for most of this period of time, could not compete with an 11 to 12% per annum growth rate in paper assets. So gold diminished as a percentage of financial wealth, not because people were not buying gold or were selling gold, and not because the gold price was declining during this period of time. It was declining as a percentage of financial wealth because because the growth rate in paper assets was so great. That changed in 2000, and as we went through the 11-year bull market, we actually saw the percentage of wealth that was denominated in gold rise to about 0.85%. All of this data is in the gold yearbook, by the way. That peaked in 2011, 2012, and as the gold price came down in 2013, 2014, we saw a decline. We've seen a further decline in the percentage of wealth. Today, it's about 0.5%. CPM Group's expectation is that it probably will rise over the coming decade because we will see investors continuing to buy above average amounts of gold and adding it to their portfolio, and we also expect to see the gold price rise. I mentioned earlier that we thought that we'd see an acceleration in the gold price in the second half of this year. That's true. If you looked at our long-term 10-year projections, we would not be surprised to see the annual average price reach record nominal levels by 2020, 2021. And that's primarily based on the idea that investors will be buying large amounts of gold due to political, economic, and financial concerns. Central banks will also continue to buy gold, and supply will decline beyond 2019. I'm going to pass the baton to Rohit and let him talk for a while. Thank you.
Thank you, Jeff. So I'm going to talk a little bit about Indian and Chinese investment demand. Indian investment demand has been in a declining trend now since around 2006, when it peaked at close to 18 million ounces. In 2016, it dropped all the way down to about 5.75 million ounces. And the decline in Indian investment demand for gold has really accelerated since around 2013, when the government started to intervene in the market and discourage investors from buying gold. In 2017, we expect a further drop in Indian investment demand. We think it would be about 4.25 million ounces. To two reasons for this. One, we think that the government's continued efforts to disincentivize investors will weigh on investment demand, as will a diversion of money from gold buyers in India from gold coins and gold bars to jewelry due to pent-up demand, which I'll talk a little bit more about in the fabrication demand section of this presentation. So since 2013, the government has really taken it upon itself to reduce gold demand in India. The reason it started doing this was because it wanted to reduce the current account deficit, stabilize the rupee. It has managed to do that to some extent. One of the first restrictions that it put in place was the 10% import duty, which has actually stayed on. A couple of the other restrictions that they put in place were taken off over time, but this one has stayed on and has in fact helped to reduce demand to some extent. In November 2015, it further added two new products to the market. One was a sovereign gold bond, and the other was the gold monetization scheme, both of which were launched in November 2015. The sovereign gold bond is really an effort by the government to encourage people to invest in paper gold versus physical gold. They pay a 2.75% interest rate on the amount of money that's put into these bonds. You can buy as little as 1 gram worth of gold. Your minimum tenor is about 5 years. In the first year of running this program, they've collected about 450,000 ounces worth of rupees in this product. Now, this is a really small amount, considering about 25 million ounces of gold is imported into the country. But that said, if you look at the trend in the amount of demand for the different tranches, you've seen an increase over the 1 year period, and we expect that this increase will continue as people tend to become more familiar with these products over time. The gold monetization scheme has had relatively less success. The aim here was to mobilize the gold held by people at home as well as in temples. There's about 640 million ounces of gold estimated as being held by Indians. In the first year of this program, you've only had about 184,000 ounces of gold mobilized. There are lots of problems, both from the consumer's point of view, one of them being that your gold needs to be melted, which is usually in the form of jewelry. And when it's returned to you, it comes back in the form of coins or bars, which is problematic because sometimes this jewelry is passed down from generations, sometimes it's got some sentimental value. And from the bank's point of view or the agent's point of view, the problems arise when the interest payment needs to be made in gold. This is because if it's for a short period of time, which is when the interest payment is made in gold, and if the gold price goes up, the bank or the agent would suffer a loss. While some of this can be offset with a hedge, the costs and the inconvenience of putting on those hedges have deterred a lot of banks from pushing these products. The government is making a lot of efforts to encourage the public to use these products. They're incentivizing the banks and the agents to push these products in the market. They have a lot of educational programs put in place. And lastly, they also have reduced the minimum amount of gold that you need to invest in. So you can invest in as little as 1 gram of gold, which helps to cast a wider net, especially among the smaller cities. The picture has been somewhat different in the case of China. Investment demand has come off, of course, from levels that we saw back in 2013, but it has been rising since the lows that it reached in 2014. And there are a couple of reasons why this is happening. So in the short term, you've really seen a move away from the lackluster performance in the stock market and the currency market, the overheated real estate market have all diverted some funds among investors towards gold. Furthermore, gold, as of the end of 2015, was really looking undervalued, given the fundamentals, the longer-term fundamentals for the metal being pretty strong. Other factors that are helping investment demand in China is the deregulation in the insurance industry, where the insurance companies are now allowed to invest in gold and gold-related products. There's also a possibility that commercial banks can start using their gold deposits as a part of their loan-to-deposit ratios, which is again something that could encourage investment demand in China. So in the medium to long term, we really see these factors further pushing up investment demand in China and offsetting some of those that lost investment demand in India. This chart shows you the amount of gold being added to Chinese ETFs. Though the total amount of gold, which is a little under 1.2 million ounces, is fairly small in the scheme of things, the trend or the growth that we've seen over the last 1 year has been pretty substantial. And a lot of this has to do with the deregulation in the insurance industry, where insurance companies were buying up these ETFs. With that, we move on to some of the more transparent indicators of investment demand. This shows us the net additions as well as the gross additions to global ETFs. We saw gold added to ETFs during 2016, reversing about half the losses that were seen in the preceding 3 years. We've seen a continuation of net additions into the first 2 months of this year, and we believe that investors would continue to add gold to ETFs. We're still about 16 million ounces short of the highs that we saw in 2012. Gold coin demand has also been rising. We saw it rise in 2015, and we saw it rise fairly strongly in 2016 as well. A lot of investors in 2016 realized that the bottom in gold prices may have already been reached in December 2015, and the rally that we saw in gold prices, especially during the first 6 to 7 months of the year, was unlike the strength in prices that we'd seen in the preceding few years, where it went up for a couple of months and then continued to decline. In the case of 2016, you actually saw gold prices sustain the rally, which encouraged a lot of investors to come into the market and buy gold in fear of having lost buying at the bottom. So you did see an increase in coin demand. A lot of this came from China. Chinese coin demand was a little over 1 million ounces in 2016, was up from about 730,000 ounces in 2015. There's also strong demand for coins minted in the US as well as South Africa. This chart shows us the net long position held by institutional investors on the COMEX. The net long positions reached a record high last year, driven primarily by gross long positions held by these institutional investors, which also reached record highs, coupled with a decline in the short positions that were built up in late 2015. The first half of last year saw these institutional investors reposition their the expectation that the Fed would continue to raise interest rates aggressively, which is what they had said in the December 2015 meeting. When it became apparent that that's not likely to happen, you did see that readjustment, which was one of the main reasons that pushed up net long positions early in the year. You also had the Brexit vote, as well as concerns over what would happen in the US election. During the second half of the year and the last few months, you saw a liquidation of those long positions. You had a slightly more positive outlook towards the US economy post the US election. You also had the Fed raising rates in December 2016, coupled with, again, an expectation of more than 3 interest rate hikes. The market was pricing in 3 interest rate hikes. There was an expectation of, the market was pricing in 2 interest rate hikes, and it sounded like the Fed was looking at 3 interest rate hikes in 2017. So that sort of led to a liquidation of those long positions and a renewed buildup of short positions last year. However, that was fairly short-lived for about 2 months, and into the beginning of this year, we've again seen renewed interest from these institutional investors, which has helped to push prices up. With that, we move on to supply. Total supply rose last year and is expected to continue rising this year as well. However, we still think that total supply will be lower than levels that it was at in 2012. So between 2008 and 2012, you had a combination of rising mine production as well as rising secondary supply. Secondary supply, which typically tends to be a lot more price sensitive, has been declining since around 2013, which has weighed on total supply. Mine production has really been the driver of total supply over the past few years, and it has continued to rise since 2008, reaching new record highs last year, and we anticipate that it would break another record this year as well. So what's been driving mine production has been this immense amount of capacity that came on stream between 2011 and 2016, which was about 15.7 million ounces of new capacity that came on stream. This was in response to strength in prices between 2002 to 2011. In 2016, about 1.9 million ounces of new capacity was added, which was relatively smaller than the additions in capacity during the early years, like between 2011 and 2014. One of the main reasons for this is a scaling back in expenditure by mining companies, as well as a suspension of a lot of projects that were viable when commodity prices were rising, but were not financially viable when commodity prices began to come off. And so what you notice is the cost and grade profile of the projects that have been brought on stream in recent years is actually much improved from what it used to be when commodity prices were going up. So in 2011, the production weighted cash cost for the projects that came on stream were about $900 an ounce, whereas since around 2014, it's been about $450 to $460 an ounce, which is nearly half of what it was in 2011. Part of that has to do with an improvement in the grade, which also rose pretty meaningfully over the same period of time. When you look at the cash cost curve across the industry, you see that on a production weighted basis, the cash costs have somewhat plateaued in recent years at around $670 an ounce. However, what you do see, so what you're looking at here is a comparison between Q3 2016 cash costs versus Q3 2015 cash costs. And what you really see is a reduction in cash costs to some extent at the higher end of the curve. All-in sustaining costs continued to decline into the first quarter of last year. There was a nearly 27% decline since the third quarter of 2012 to the fourth quarter of 2015. We did see all-in sustaining costs rise somewhat during the second and third quarter of 2016, and we do think that the bottom for these costs may have already been reached in early last year. There's really little that can be cut back. So these all-in sustaining costs are composed of cash costs as well as sustaining costs. And as the previous slide showed, and as we've seen behind this data as well, that the cash costs have really been fairly stable around $650 to $700 an ounce. It's the sustaining costs that have really been scaled back by mining companies, and there's really little to be squeezed out from those costs. Furthermore, there's an improvement in sentiment among the mining industry regarding prospects going forward, which is also helping to bump up the sustaining costs a little bit from where they were at the beginning of 2016. This chart shows exploration spending, which continued to decline into 2016. We think that it would stabilize this year, even potentially rise. As I mentioned, there's been an improvement in the sentiment in the mining industry regarding future prospects, as well as the costs. These costs have really been scaled back strongly and would essentially make mining unsustainable if these costs remain at these low levels. One factor that has helped mining companies a lot over the last few years in this period of low commodity prices has been the strength in the US dollar relative to major gold mining countries. And so you can see that the relative benefit is obviously differs from country to country, with Russia benefiting the most, whereas Canada and South Africa also benefiting in meaningful ways at over 20% decline in the currency values versus the dollar. So this basically helps to reduce the subsidize the cost for these mining companies and helps to offset some of that weakness in commodity prices. With that, we move on to fabrication demand. Fabrication demand declined last year for the first time in 6 years. The primary reason here was a strength in gold prices. Fabrication demand tends to typically be very sensitive to gold prices. You also had a stronger dollar relative to a lot of the major consuming countries, which also weighed on demand. You had Chinese buyers essentially shifting away from jewelry purchases to buying investment gold products like coins and bars. And you had a couple of problems in India, which I'll get into in the next slide. And also you have a longer term trend in both India and China, where the desire for having heavy carat gold jewelry is dying out, and you're basically seeing consumers move towards more low carat gold jewelry, which is again another factor that weighs on total gold fabrication demand. So in the case of India, you had drought conditions in 2015, which affected farmers' incomes in 2016. And farmers in India are a major consumer of gold. So reduced spending power for farmers essentially meant reduced jewelry demand in India. You also had demonetization of the Indian rupee at the end of 2016 in the last 2 months, which hurt gold demand. There was essentially chaos, and there was no money in the market to be buying gold. And then, of course, you had the stronger gold price and the relatively weak rupee, which further weighed on demand. In 2017, we actually believe that the first 2 points, the reduced demand from farmers in 2016 and the loss of demand due to demonetization in 2016, will result in pent-up demand for jewelry, which should be good for fabrication demand from India during 2017. You do have a clampdown on black money. There's been a strong push towards reducing black money in the country, and one of the main stores of black money have either been real estate or gold. So now they've created new restrictions with regards to how much gold can be bought with cash. So that should be another factor that would weigh on demand for gold in India during 2017. You also have the goods and services tax, which is expected to be implemented around the middle of the year. There's a lot of uncertainty regarding how much the tax will be for gold. You have jewelers wanting a 2% tax. You have the government wanting a 4% tax, and you have bullion traders wanting a lower tax, a lower import duty and a higher tax. So depending on which party it is, they have different They have different factors driving what levels of tax they want, and there isn't real clarity at this point. But we think that the lack of clarity on what the tax for gold would be going forward should bump up demand during the initial months, which we think would be offset by reduced demand once these taxes come into play. So with that, I'll pass it on to Jeff to talk about official transactions.
Thank you, Rohit. Briefly, central banks have been buying about 5, 6, 7, 8 million ounces of gold over the last couple of years. We saw this chart basically takes the broad scope of history, and you can see up until 1967, central banks were net acquirers of gold, and that was under the gold dollar Bretton Woods currency system. Central banks used gold to settle international trade, and they added the gold to their monetary reserves. That ended, or it began to end in 1967-68, and we entered a long period of time with demonetization. You can see that from 1989 until 2007, there was an extended period of time in which central banks that had accumulated gold prior to 1967 were selling some portions of their gold. In some countries, it was half of the gold that they had accumulated prior to 1971. In other countries, it was a smaller or a larger portion of their gold. That demonetization period basically drew to an end around 2005, 2006, 2007, and we saw those central banks that were selling some portion of their gold pulling away from selling, while we also saw other central banks, many of whom had not been major trading partners, trading countries prior to 1971, but had become large exporters and thus large importers of U.S. dollars, which were used for most international trade settlement and capital settlements since 1971, starting to convert some of their dollar holdings into gold, euros, and other currencies as a part of a diversification of their monetary portfolio. So as we saw some central banks pull back from selling, we saw other central banks begin to increase their sales. And there actually have been a number of central banks that have been purchasing gold during this period of time. The most prominent are China, Russia, and Kazakhstan, but a number of other central banks have come in since 2005, 2006 as one-time or sporadic buyers. I want to look at the Bank for International Settlements. The Bank for International Settlements has about 6 million ounces of gold that it holds. You can see large fluctuations. There was some diminution in the amount of gold they held in the period 2005 to 2009. Then it shot way up, came back down, and now it's shot back up again. What we're seeing with the Bank for International Settlements gold reserve levels really since 2009, it does not reflect BIS gold policies, nor does it reflect changes in their actual reserves. What we saw beginning in 2009 was that the BIS was entering dollar gold swaps in order to provide dollar liquidity to commercial banks, primarily in Europe. These banks were facing severe liquidity problems during the global financial crisis. They were also facing increased reserve requirements from the BIS and the international banking system at the same time. In order to meet those liquidity requirements, they swapped gold that they held on an unallocated basis for investors and depositors. They swapped that gold for dollars to give themselves the liquidity they needed. That occurred in 2009, 2010. Saw a little bit of a plateau. By 2013, 14 into 15, you actually saw the unwinding of a lot of these swaps, and in fact, some increased sale of gold during that period of time. Beginning in 2016, we saw the BIS begin to re-enter the gold dollar swap market with these banks. And so we've seen an increase in the amount of gold that the BIS is reporting on its balance sheet. And that really reflects increased instability and liquidity issues in the European banking market. It has no effect on monetary gold reserves per se, but it actually is a bullish indicator for gold because it shows the stress that you're seeing in the European banking industry, and that stress often is reflected by investors, both institutional and individuals, moving some of their money out of euros and other currencies into gold. Going back to actual central bank monetary reserves and changes in them, you can see here the gross reductions and gross additions. Again, you can see that from 2004 through 2010, you still had residual sales of gold coming out of central banks that were reducing their gold reserves, most of which had been built up prior to 1971. And then beginning around 2008, you saw a large increase in gross additions and thus net additions from central banks, again, primarily Russia, China, and Kazakhstan, that were looking to diversify their monetary reserves. This is the same data on a monthly basis, and again, you can see the preponderance of net purchases and gross purchases over the period of time. Our last chart is gold stock demand. CPM Group follows pretty conventional research methodologies in studying markets. So we look at total supply, mine production, secondary recovery, and other sources of newly refined gold entering the market, less fabrication demand in the case of gold, and that equals a surplus or a deficit. And then we go into the market and we say, well, how much of that metal that is in surplus or deficit is going into central banks, how much of it's going to private investors, and how much of it is staying in the market as working stocks held by market-making banks and brokers. So we divide our gold market data into total supply, fabrication demand, and stock demand. This chart is a compilation of official gold purchases by monetary authorities and investment demand by private investors. And we should say that investment demand by the private sector includes sovereign wealth funds. We differentiate between central banks, which have monetary reserves and treat those monetary reserves as a quasi-permanent holdings, and sovereign wealth funds, which are charged by their governments to invest as opposed to holding monetary reserves. So those are financial assets, oftentimes with a 3 to 5 year time horizon. And what we do here is we combine central bank demand with investment demand from the private sector and sovereign wealth funds to show total stock demand. And you can see that it remains high. We have gone through a secular shift beginning around 2002, and we continue to have that large period of time where investors and central banks are buying more and more gold. I said earlier that we thought that the gold price would rise sharply in the long run beyond 2017, predicated really on three fundamental factors. One is strong investment demand, which you can see here in the black bars. The second one is continued buying of gold by central banks. Central banks tend to be more price sensitive than private sector investors. So as a result, you probably will see central banks buying less gold than they otherwise might have because the price will be higher because of the private investment demand. And then again, as that pipeline of new production dries up and you start seeing declines in existing production, you'll see the investors and central banks competing for newly refined gold supplies at a time when mine production begins to decline. And we think that that's probably the major factor. We're going to open it up for questions now. And again, you can ask the questions by typing them up, and Matt Taub will read them to us, or you can dial in and speak on the speakerphone. Thank you for your attention. We will have launches on silver and platinum over the next few months, but let's go back to this chart while we take questions.
We do have a question. Can you discuss what is the impact of the Shanghai Gold Exchange and the efforts to make yuan reserve currency?
Well, the Shanghai Gold Exchange is becoming a major gold contract. China is today the largest mining country of gold, the largest refiner, the largest investor, and the largest fabricator of gold. So China has become a significant part of the gold market, and it will continue to be. Shanghai Gold Exchange is the exchange that the government has signaled should be used to transact gold physical transactions, and it continues to be so. We think that in the long run, it will become ever more important to the gold market. Our view is that the People's Bank of China does not necessarily want to see the yuan become the reserve currency of choice, but what they would like to see is, on a long-term basis, increased liquidity internationally in both the yuan and in other currencies, so that there is a multipolar currency regime in which investors are able to hold their assets in a number of currencies other than just the dollar. I don't think that the Chinese government or any other government particularly wants their currency to become the reserve currency of choice, because that bears with it certain responsibilities that historically have been negative for the countries issuing those currencies. But I think the Chinese posture, like that of many central banks, is to look for a more multipolar currency regime, which could take decades to emerge.
Why has unallocated paper gold made a comeback relative to physical? Is this a reflection of cost, trust in the financial system, or the end of another mania?
The question was, why has paper gold or unallocated derivatives made a comeback relative to physical gold? I'm not sure that it actually has made a comeback, because as you saw from our charts, you've seen you've seen a large increase in physical gold purchases as well as derivatives. We have seen increases in paper gold. I think that you have radically different investors, or sometimes the same investors with different portfolio tranches involved in paper gold relative to physical gold. A lot of our investors, I mean, our advice to investors that we advise is that they should have some physical gold, but if they are interested in shorter term transactions, they should work with forwards, exchange traded options, and futures. And I think what you're seeing is, as I talked earlier about this new entrance of people into the gold market, one of the groups that you're seeing are much more shorter term opportunistic investors. These are people who came into the gold market in many cases for the first time in 2006. They exited around 2012, early 2013, and now they're coming back into the market. A lot of the shorter term investors are not interested in owning physical gold or not having a significant portion of their assets in gold, but they are interested in the leverage that futures, forwards, and options provide them. And then again, as I said, our advice to investors often is that they should have a position in physical gold, but they should also, if they are so inclined in having shorter term investment portfolio strategies, use futures and options and forwards for those.
Are there any other questions? If you prefer to speak, you can just click the little hand button icon, and you'll be able to ask the question verbally.
Okay. If you could go to the last slide, Matt, you have to release it. Okay, again, thank you very much. I hope this worked well. It was definitely more comfortable sitting down and speaking about gold for an hour and or so than it usually is to stand up. We hope to do this again at the end of April with our Silver Yearbook, and then in the middle of June with our Platinum Yearbook. And thank you for being here, and we hope to see you then. Goodbye.